Okay, good morning and happy Tuesday, everyone. I hope everyone's doing well. Welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and today we have a lot of charts to share with you, especially regarding the current market conditions and tracking the recovery. So let's go ahead and get started. But before we do, what we're going to discuss here today is for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, for those of you that trade using your mobile platform, the new iOS platform here at Firstrade is an incredible tool to help you manage your complex orders. I've used it to enter multi-leg complex orders, manage your existing orders, being able to cancel and replace complex orders without having to cancel them and place a brand new order, and also helping you manage your complex orders. So for those of you that trade spreads or any of those complex trades, make sure that you take a look at the iOS and Android platform. So we're going to go over quite a few things here today, but predominantly what we want to talk about is the current market update and talk a little bit about the health of the current market rally, because we've been getting a lot of questions from users as far as whether we think markets are going to reverse lower. Certainly when we poll retail investors, there's a very large percentage of the community that believes that markets are going to correct lower. Many times that is actually a contrarian indicator. So we want to take a look at what indicators are we paying attention to give us a sense for the directional view of the market. And then what I want to do is I want to take a look at tracking the recovery from an economics perspective, just to put into perspective where equity markets are trading, where economics are currently, indicators are currently pointing to, and how divergent are the two. Taking a look at the earnings data. So between the recovery data and the earnings data, this is really where we believe a lot of the outperformance in equities have come from. And I want to show you that outperformance versus what our expectations were prior to the recovery. And then lastly, we'll go through some of the ideas. And if we have a few minutes at the end, we'll answer your questions and answers here at the very end. But the primary question that I want to help answer is due to the continued questions that I get over the past few weeks regarding, are markets going to recover? Are markets going to pull back? And I've distinctly said over the past few weeks that despite things looking stretched, despite things looking overbought, despite the negative divergences that we keep identifying here in the broader markets, remember that equity markets can get stretched for a long period of time, months at a time, before they kind of quote unquote burst, if you will. So the question is really, how far can equities go before they burst? My name is Tony Zhang. I'm the chief strategist here at Options Play. And today what I'm going to do is I'm going to share with you my charts, my research that I'm currently paying attention to that informs me on my directional view and decisions in terms of how I'm positioning for this market. And lastly, share with you some of the ideas on my radar here for today. So we'll start off with the S&P 500. This is one that we always talk about and take a look at first. We've last week managed to break back above the 323 level after the first attempt failed. Now that we've had the second attempt, momentum indicators have confirmed that move higher, so we have resolved some of that negative divergence. The weekly chart, as you can see, we are just spitting distance away from that all-time high of 339. Our expectation is within probably today or tomorrow, we'll hit that 339, see if we can break out higher, retest this, and potentially move higher here. So at the moment, everything is looking very bullish here for the markets. If you look at the daily and weekly money flow, very strong. Momentum indicators now confirming the moves higher. So we have a fairly bullish setup here in the markets. Now, I say cautiously bullish because of a few of the other things that I plan on showing you here today. If we look at the Qs, the NASDAQ 100 index, last week we talked about a triple top at 270. We had multiple tests of 270, but over the past few trading sessions, we've now had a break above that 270 level. We've come back to test that 270 yesterday and held that level. So my expectation going forward is that the Qs are going to rise off that 270 triple top, which now acts as support and continue moving higher. Now the Qs are a little different than the NASDAQ than the S&P 500 because we've had multiple rallies here with higher highs, but each one of them has sustained lower highs in terms of momentum. So we're continuing to see negative divergence here on the Qs. But as of right now, does not look like we're going to get much of a pullback here. Maybe today we get a little bit more of a pullback, but the 20-day moving average has consistently provided solid support, and we are trading just above that 20-day moving average at the moment. We're probably with about $5-6 away from that 20-day moving average. So that is certainly one that we're paying attention to. But the weekly chart still shows that negative divergence where we have a higher high, but not a confirmed on the momentum indicator. But money flow remains relatively strong. So this is concerning to us, but in itself is not enough of a reason to short the markets. As a lot of the questions that I've been getting over the past few days as far as, is it time to short the markets? Now, we talked last week about IWM. We talked about small caps breaking out here. We did finally get that breakout here above that 153 level. We are now within spitting distance of the 160 level. 160 is, I would say, an important level because 160 provided resistance for a good portion of 2018. Finally broke out above it. Barely really moved much above this level and before it crashed down during the coronavirus. Now the question is whether we can break back above this 160 level. If we can break back above 160 level, that again is a net positive here for the broader market rally here because you want to see broad participation across the equity markets. So when the Russell 2000, the 2000 smallest cap names are rallying along with the mega cap names, that is healthy for a market. What we did not see is that same rally during the November to February rally. As you can see, small caps barely moved higher here during the time when both the NASDAQ 100 and the S&P 500 continue to move higher here. So broadly, if you look at S&P 500, big cap, if you look at NASDAQ 100, technology, if you look at small caps, broadly all participating in the rally. That is, again, healthy for this market. And we have a fair amount of healthy sector rotation. Yesterday, we had energy, financials, industrials really spark a huge rally. After technology, healthcare, and communications took a back seat, this type of sector rotation is healthy for the market, unlike where you have just a couple of sectors really dominating the moves. Now, the one concern is that equal weight is sort of pulling its weight, but starting to lag behind here. So equal weight, for the most part, staying on track with the market recovery. But as of right now, equal weight is lagging behind. It played a little catch up here yesterday, but we certainly are seeing leadership narrow across the board. Narrowing leadership is concerning. So we have quite a few net positives, but we also have quite a few net negatives here. Equal weight not quite being able to pull its weight, not quite being able to catch up is one of the concerns here of the health of the market rally. The dollar continues to weaken here. So we talked about the dollar breaking below the $96 level, which is a significant level going back to 2008. Multiple support levels here, finally breaking down below a few weeks ago. We had a continued move here from 96 down to about 92 and a half. We spent the last couple of weeks consolidating, and it looks like it's about to start that trend continuing lower again. This has ramifications for gold. This has ramifications for silver. Any of the commodities, we've seen the softs and the mining. Base metals start to rally again as a result of this. So this is where we do expect to see a continuation of the dollar weakening and strength from the euro, from the Swiss franc, these types of currencies. For those of you that are currency traders, even Bitcoin, rise can be tracked down to this dollar weakness for those of you that do trade some of those cryptos. So gold, last week we talked about how we thought this was going a little too far too fast in terms of gold. We have now gotten a correction back to that 20-day moving average envelope. This is the type of correction that we typically look for before we want to seek a further long opportunity on something that has risen this fast. We usually don't want to chase this. Now, in addition to that, what we generally want to do in these types of market environments where things are very stretched, as you can see, gold got extremely overbought, came back below it. And this is an opportunity to start looking for long opportunities, but there is still a risk of a further pullback here. So my preference is that if you're going to play a further rally in gold, in silver, any of the base metals, to do so with a call spread. meaning you want to try to limit the amount of risk that you're taking with this type of move. So if, let's say, you wanted to take a bullish view here on GLD, GLD pulled back to around the 185 zone here pre-market. So we're down about a little over 2% here. So gold, fairly volatile trading day. My suggestion to you is if you're looking to play for further upside, look at something like a maybe a 185, 200 call spread, something along these lines, a call spread where I'm risking here about $5.50 for a $190 stock. And just to put that into context, $5.50 on a $190 stock is only roughly 2%. So we're talking about 2% of the, slightly under 3% of the gold's value that you're putting at risk. The gold GLD is down almost 3% itself today. Here, you're only risking roughly 3% until September 25th. That's how you want to play for further upside, because this type of trade pays you almost 2 to 1 if you're right and gold continues to rally, but you're only risking a little under 3% of the ETS value to take that bet. So if gold does continue to decline, you're risking 3% of GLD as opposed to outright buying GLD at 185. So that's how I'm looking at gold here at the moment if you're looking to look for a pullback here. Now, some of the net negatives that we're currently seeing really comes down to a lot of the complacency, and we're seeing a record level complacency in terms of the put call ratio, the weekly put call ratio down now, the 20-week put call ratio down into the 0.66, below 0.7, which is certainly a very complacent level that we haven't seen in ever. These are historical lows, and we've seen historical lows on a lot of things like interest rates, and this, I think, is directly tied to that. The 20-day put call ratio is down to 0.55. So last week we started to see a little bit of an improvement, but that didn't last, and put call ratios continue to move lower. Again, these are record level lows. We have never seen these levels ever on the put call ratios. So this is showing that the markets are extremely complacent. When markets are this complacent, this is generally speaking seen as a contrarian indicator that a higher risk of a pullback, and especially in this current market environment, I think the risk of a pullback is not just the risk of a pullback, but also how fast and violent they seem to materialize these days. That's why we need to be really prepared for a potential pullback, but we don't want to do it too early, because we see, for many investors over the past month, even about a month ago when we held some polls about, where investors felt equity markets are going to go, almost 5 to 1 investors felt markets were going to pull back. And we saw some investors buy put options, and we said that we think it's too early. There's no signs of potential pullback just yet. And that did happen. So we want to, again, stress that despite the fact that we see this complacency, we see it both on the put call ratio. We also see it on the VIX 3-month VIX ratio here, now above 0.25, which we usually don't talk about very much because it never gets above 0.25 very often. But when it gets above 0.25, that's the exact opposite of when it goes below 0. When it goes above 0.25, that's usually considered more of a bearish indicator. More of a market top indicator, rather than when it goes below 1, that's a sign of the markets reversing lower. So we're seeing complacency across the board, but I want to stress again, just because you see complacency, just because you see markets are overbought, just because you see negative divergence, that in itself does not signify a reversal. That just means that the risk of a reversal is higher. You still want to wait for actual signals of that reversal before you go out there and buy puts and move your assets into cash. Now, the scary thing about these types of markets is that reversal can happen very quickly. We certainly see a lot of things on the radar that could potentially cause it, whether we're talking about Democrats and Republicans not being able to reach a deal or the deal that they reach coming down significantly below expectations in terms of what fiscal policy response will be post July 31st when the unemployment benefits run out. And if you think about geopolitical risk between US and China, these are all potential catalysts that could cause a sell-off relatively quickly. News with the vaccine. Russia just registered an actual vaccine for human use. Now, there are some concerns about the efficacy of that vaccine and what clinical trials and what medical procedures they went through to register that vaccine. So we're going to see some of the details about that in the next few trading days. But there's a lot of things that could potentially cause a sell-off. We don't know what those things are going to be. It's just important that we understand the risks at the moment. So I did want to give us a sense for, now that equity markets, S&P 500 back at all-time highs, the Qs well above all-time highs, where do the economics track in terms of the recovery? Because if you just look at the equity markets alone, you would expect a very V-shaped recovery, meaning we've basically gotten ourselves back to pre-COVID-19 levels. But one of the things I wanted to point out here in terms of the recovery using economic numbers, specifically employment numbers, we see that we're far from pre-COVID-19 levels. So just to give you a sense for total non-farm payroll, this is the employment numbers that we typically look at every single month that comes out on the first Friday of every single month. Just to give you a sense, we have recovered only about 42% of the jobs that have been lost since February 2020. That is concerning because the equity markets do not reflect that at all. However, I will say that the reason that I think part of why equity markets have recovered so fast or so much is due to the fact that every single jobs number we've had since May has surprised us to the upside. They have been better than consensus had expected, and markets are rallying off of that good news. There are signs that this job recovery is slowing down by a significant amount, especially going into August and September. We'll have to see where those numbers come in and whether they come in still above consensus, but certainly there is a slowdown here. But just to put into perspective, only 42% of the jobs that have been lost have been recovered. That is far from back to normal. That is a big concern to me. The S&P 500, now that 90% of the S&P 500 has reported earnings, this is one of the numbers that also has surprised us to the upside. The earnings have only lost roughly, corporate profits year over year has lost about 33% compared to the same time last year. Now, the expectations before we started this particular quarter was a 44% drop in corporate profits. So when you go from an expectation of negative 44% to only a drop of 33%, that is a significant margin. We've never seen beats that size because we've never had earnings a dent to earnings this large, but that is a pretty significant margin in terms of expectations, in terms of earnings. Sales came in roughly in line with expectations. Expectations was about a decline of about 11-12%. It came in at about negative 10%. So significantly, relatively small decline in terms of sales, but earnings, the big number, that's where we had the big beat. 77% of companies beat on earnings, 66% of companies beat on sales, 59% of companies beat on both. So those are some record numbers as well. And that points us to why equity markets have been so positive, are due to these types of beats, if you will, meaning these economic and earnings numbers coming out better than expected, but the overall numbers themselves are still pretty bad. For earnings to be down 33%, but trading at all-time highs, that is obviously the two don't match up. We're seeing this across the board in terms of estimate revisions for both sales and earnings. As you can see, the vast number of sectors seeing a positive revisions in terms of earnings per share, as well as in terms of sales. Only financials and utilities and energy are the sectors that have seen a negative revision here from analysts for this particular quarter since July. So a lot of positive expectations and optimism in the markets because companies reporting better than expected. As far as the earnings calendar, it is fairly light now, with 90% of the S&P 500 having reported earnings. This week we have Cisco, Applied Materials for the semiconductor stocks, Baidu and Alibaba, obviously both stocks that have been affected by the geopolitical risks between US and China. Definitely important to pay attention to. Home Depot, Walmart, Target, NVIDIA. These are the ones that I think most investors here are really paying attention to here for the next couple of weeks. But as you can see, fairly light on the calendar. You have some big discretionary names coming up. So pay attention to those. Discretionary, one of the strongest sectors here at the moment. So I wanted to point you to some of the ideas that we're currently paying attention to, some of the breakouts and opportunities that we currently see. So Silicon Valley Bank, one of the few banks that have shown a fair amount of strength here, is just touching this 240 resistance level here, this double top here. And if we look at the equity markets as our template, our expectation is to see a breakout here from above 240 into that 260, fill that gap here. So Silicon Valley Bank, especially with financials looking fairly strong yesterday and looking even stronger here today, XLF up almost 1.5% here pre-market. We expect that Silicon Valley Bank here will break out above that 240 level and rise towards that 260 level here to the upside. Limited brands. This is one that really hasn't been on our radar for quite some time just because of the sheer decline in this particular name, the retail name that really has been decimated. We've seen a bit of a turnaround here. We've had continuous lower lows, but recently started to put in a higher low. So what starts to look like a bit of an inverted head and shoulders, and looks like it's starting to break above that neckline here. As you can see on the daily chart here, it finally broke out above that $25 level, broke out above that $25 level, came back to retest it, and is now starting to move higher here. So you have quite a bit of room here to grow to the upside here. You have that $35 level, 200-week moving average as your first target here in the long-term chart with the weekly chart. It is overbought, so again, to play this to the upside, my preference is to use call and call spreads. That allows you to play for this upside while doing it in a relatively limited risk strategy. Freeport McMoran, this is a mining stock. This is one that obviously is also, an industrial stock. This is one that is starting to break out here as well. We've had this breakout here above this $13 level that had struggled with quite some time. Broke out, came back to retest this over just a couple of trading periods, and looks like it's about to start heading higher here. You have strong money flow here on both the weekly and daily charts. Momentum confirming these moves higher. So you've got this long-term bottoming formation, and looks like it's completing that and starting to potentially move higher here. So FCX is one that I'm paying attention to. AVGO, Broadcom, this is one that we're also paying attention to in the semiconductor space. So you have a massive triple top here around 330 or so, finally looking like it's about to break out here. Certainly on the short run, where 320 was that resistance level for the past few months, broke out above it, came back to retest this as support, and that can potentially start moving higher here as well. So those are some of the ideas that we're currently paying attention to from a chart perspective. At this point, I have a few minutes to try to answer a few questions if anyone has any. But again, I hope that you find this useful in helping you better understand where currently we sit from a macro perspective, how you should position yourself, because we do continue to see potential upside here in a lot of names, but you want to make sure you understand what the risks are and how to position for that specifically, okay? So Eric, thank you so much. Raju, why Microsoft going down now? What's your opinion? This really just comes down to technology needing to take a breather. I would argue that 206 is not considered Microsoft coming down. This is just, think about it. This stock has gone from 150 to 200. This is not a high-flying stock, right? This is not like Tesla. This is one of the largest market cap names in the world. For it to go from 150 to 200 straight up with no pause is not normal. So you need to see some type of consolidation, and I think this provides you with an opportunity to seek a long position. You never want to chase these names at all-time highs. You want to wait for a pullback. And this pullback below the 20-day moving average, I think, is a good opportunity to potentially go long. Notice how often when it pulls back to the 200-day moving average, it provides you with an opportunity to go long. Those are your entry opportunities here. Silver is the same thing as gold. That's why I skipped it today, because you've got the pullback here into the $25 level. You never want to chase these types of highs. A pullback here to 25.31, I actually think you can get even a further pullback into the 24s and 23s. I don't like chasing silver. I prefer, I've been trading gold. Gold has gotten back into the 183 level. So as you can see, just spitting distance away from the 20-day moving average, those are the types of entries that I specifically like. So GBTC, I have no idea what that is. Grayscale Bitcoin Trust. So I don't know if this is just a Bitcoin ETF. But certainly any dollar denominated assets like gold, silver, Bitcoin, potentially has, in my opinion, some legs, especially as dollars continues to decline. Tesla is now trading below that 20-day moving average. So if you're bullish on Tesla, I see this as a potential opportunity to look for a long here in Tesla. What do you think about Square? Square, still trading above that 20-day moving average, pulling back a little further here into the 138s today. Looks like it's about to fill that gap. So between filling that gap and pulling back to the 20-day moving average, if you like Square as from a fundamentals perspective, which I can't say that I particularly do, I think that this is a good entry, and again, using call spreads to limit your risk for further upside. Do I think Wells Fargo will follow the other financials up? So Wells Fargo is by far one of the weakest of the financials, but it certainly is going to lift with the whole tide here. So XLF up about almost 2% pre-market here, 1.68%. So Wells Fargo certainly is going to play catch up there as well. How far is XLF going to go? That's where I don't particularly think that we're going to see a big move here in XLF or any of the financials, but financials rotating currently. If you want to play a short-term play, that certainly can be worth taking a look at. ARC ETF. I know nothing about this ETF, but it looks like a pretty strong chart both on the daily and weekly, pulling back every time it pulls back to the 20-day moving average, provides a nice entry here. And that's exactly what you're getting here today. So, but I know nothing about this ETF, so I can't comment much beyond that. Apple, this is a stock that I continue to like. I don't particularly like chasing it at all-time highs. I would like to see a pullback here towards the 420 level before I look for a long opportunity here. I don't have a position in Apple. I may not get that pullback here. I think you're likely going to get a very shallow pullback, maybe into the 440 levels before it continues to move higher. But it's certainly a stock that I quite like. Kodak puts. I really don't like playing these types of names that are just completely based on hype. There's no real fundamental story here at all. Maybe you can buy some puts, but I would imagine puts are so expensive that it's probably not worth doing. Okay, so thank you so much. I hope that you guys find this useful in helping you set up your day and your opportunities. And we will send out the recording to you guys as soon as we're finished. And I'll see you guys here next week. Have a great day.